would like to ask you to just briefly, he has introduced himself already. Ralf, would you just do a quick introduction?
My name is Ralf. I'm a managing partner of Dr. Lübke in Kelber. That is a owner-managed real estate operating platform in Germany. We have 60 people on the ground operating through 6 offices. But for those of you who've spotted that I'm also wearing a different name on my badge, that's right. I also have a second hat on, and that is I'm a board member of Arbireo Capital. That is the affiliated investment manager of our platform. And through Arbireo, we are co-investing in transactions that we are sourcing and structuring for other people.
Okay.
Right. My name is Schubart. I'm Director International Client Management, working for 10 years now with Corpus Sireo. Corpus Sireo is the leading third-party service provider in asset management in Germany. 10 locations, 560 people on the ground, managing roughly all in all 16.5 billion euros assets, mainly focusing on office, residential, retail, and healthcare.
Thank you. Yeah, Ralf, first question to you. All big markets in Germany have improved nicely over the last 2-3 years. For anybody like you planning to invest in Germany, is it still the right time to enter the market?
General answer, yes. I think it's, that's not just because that's my business, but I genuinely believe it's only the beginning that we're seeing, and the reason for that is that it is a very strong sector in a strong market, and it's structurally sound. I mean, the charts and the slides that you presented are outlining, let's say, the environment in which we're operating here. Rents are increasing at a reasonable pace. I mean, average probably 2 or 3% over the last 10 years. We have very resilient occupier base. I mean, the average person or the average tenant has seen a real increase in wealth over the last years, so rents are still affordable. We have limited supply in terms of new construction and production developments on the market. I mean, if you, for instance, pick out the listed real estate players, the residential real estate players, the guys like GSW and Deutsche Wohnen, their average value per square meter is probably around 900 euros. Now, the average replacement cost for such a building is between 1,500 and 2,000 euros a square meter. So, if you think that through, then economically, it actually doesn't make any sense to develop new buildings if you then rent it out at 5 or 6 euros. It makes sense if you can rent it out at 10, 12, 14 euros, or you basically construct things which are earmarked for sale. And I think that we've gone through also a phase of increasing professionalism in Germany. I mean, players have become much more professional in terms of how they operate on the ground. Just take a look at the listed sector, and I would, last but not least, I mean, the 5% yields that you've shown as an average, if you compare that to the 10-year yield of bonds, which are 1.7%, we are talking 330 basis points premium between government bonds and residential. So I think that in summary, it's a safe place to invest for investors.
Thank you. Kai, you're working with international clients. What are they investing in? What have they been lately looking at? What is their strategy? Which cities are they preferring for their investments?
Well, actually, over the last several years, well, it started in 2002, 2003 with the first international investors investing in residential real estate in Germany. And over the periods of time, there were different attitudes and different strategies that were successful. What I would like to point out is one thing which is very, well, it's obvious, but it's very striking. Germany is the federal state, so it is totally different from the structure-wise to France and England, for example. the federal structure of Germany gives the opportunity to not invest in one hub. So what Charles just mentioned in his first statement, that coming from the Expo, Berlin, residential, Berlin, and residential were the key notes. This is something that you have to bear in mind, that it's not just one city, it is not just the top 5 or top 7 cities which are really interesting for real estate, especially for residential investments in Germany, but the federal structure, which is has been over a long period of time. The fact in Germany indicates that investing in regional prosperous areas is a very good strategy to apply. So, for example, if you see international investors who are from France or from England, who are used to some centric situation in their country, got to know the situation, or they understood part and part the situation that in Germany there's a possibility to go in different areas and to really find very stable and prosperous markets throughout the country. So this is something that for international investors who are first focused on the top 5 or top 7, then come to the idea and to the solution that it's not just the top 5 where you do have a lack of supply, where everyone is looking for these areas, and so the strategy to go in the federal structure of Germany is something that more and more investors really apply.
You have 6 offices in Germany. 5 of those 6 are in the big city, and 1 is in Dresden, probably for good reason. Now, as an investor coming from abroad, coming from England or elsewhere, what would you tell them? Why should they invest in Dresden rather than in Stuttgart or Düsseldorf?
Because you probably get better returns for a similar risk profile. And it's actually nice that you're pointing to Dresden. Yes, it's the office which is outside the big 7 definition, but I give you a real case study. We are managing roughly 4,000 residential flats in Berlin and Dresden for a very large Scandinavian institutional investor. And we've been doing that for a couple of years. Initially, they approached us and said, here are 200 million equity, go and find the right product. So we defined the investment criteria, and we've on purpose also chosen Dresden because even though it's smaller than Berlin and some of the other locations, it has a very sound structure and demand and supply.
And a debt-free city.
And a debt-free city.
1 of 2 in Germany.
Also a function of a very large transaction that happened somewhere a couple of years ago. But the point is, so we bought these 4,000 units, and we've been asset managing since then for those institutional clients. And in Dresden, the net cash return that we're generating for this investor, and that's a pure equity investment. So they've refrained from putting any leverage on that. They've also refrained from any trading. It's a pure buy and hold. And once in a while you optimize, it's 6.1%. So that's the bottom line. Now, try to achieve that in a market like Frankfurt or Hamburg or Munich. It's probably impossible, at least if you leave leverage and other tricks outside the equation.
So there's probably more than Dresden, more cities like Dresden, like when you look at Leipzig, when you look at, should there be a difference between Leipzig and Hanover, for example, cities of equal size?
Yeah.
The industry has grown in Leipzig. I mean, it's the car manufacturing, there's chip industry,
Yes.
there's between Leipzig and Dresden. So it's kind of a strong area in the eastern part of the new Bundesländer.
That's right, and I think, I mean, we've heard already on the panel on your discussions. Let's not just focus on the capital. You have big 7s. I would say you have 70 cities in Germany with more than 100,000 inhabitants spread across the country. So cities like Dresden, or even go smaller, I mean, Erlangen, for instance, or other cities, names might not say anything to you right now, but the point is, it's a very diversified, granular market, and there are places where you can generate above average yield for a very safe product. But the point is, you probably can't source and definitely not manage that product on a, let's call it, fly-in, fly-out basis. You need the people on the ground who are able to scout the product for you, to make the transactions, and then, very importantly, to manage the real estate.
The new German government is in the midst of, forming the coalition. So there's still talks between the Social Democrats and the Christian Union. They're about to finalize that within the next 4 or 6 weeks. But there are already talks that concern the residential real estate arm quite a bit. Amongst others, there are plans to limit the rent for new lease agreements to a maximum of 10% over the rental table, or Mietspiegel for that matter, if that is a term that you're familiar with. And then the next thing is, on existing lease agreements, you should be allowed to increase that only by 15% over 4 years. Now, Rainer, what do you think? What are the chances that something like that is coming through? And can we expect more poisonous stuff from this coalition that is about to start at the beginning of next year?
Well, I think sometimes the good intention does not necessarily result in the good results. So what does this coalition want to do? They want to stabilize the market, they want to stabilize the rents, and yet at the same time sort of motivate investments. And that's exactly what you see in what they, well, not deliberately, but what obviously has leaked from their negotiations the last couple of days, that they're looking particularly on what we would probably see at the big 7 cities, or what they define as markets where the rental situation is close, where it's tough to get a new flat for those who are not sort of fortunate to earn sort of high income. And there is a tendency that they will allow the federal states to declare certain cities as areas where it's difficult to get a flat, and that they propose 2 basic measures in those areas. One is that they will allow digressive depreciation again for a 5-year period for those periods. For those areas. On new buildings. And also, simultaneously, only in those defined zones, they will sort of put on what is called in German the rental brake, Mietbremse, on existing leases as well as on new leases. Also, what they are trying to do, just to add that, is they are considering to amend the Mietenspiegel from a 4-year perspective to a 10-year one. That's probably a very sort of hard discussion which will come up within the next couple of months, because I think it seems very clear that also, even though this is the current status of the negotiations, some of the politicians have realized what I said as an initial statement, that not everything that's meant as to be good will have good results. As we see the investment in flats, particularly in Berlin and other cities, raising now, and sort of as an immediate response to a short offer in certain areas. So the market is reacting, and whether or not sort of one will understand that it should be a separate issue to have one kind of the market for everyone, and a social housing market, and subsidies for those who sort of have other income, and to protect sort of the population which is currently living in a certain defined area, is a completely different thing than declaring the whole city of Berlin as an area where it's tough to get a flat, because that's simply not true. And the fact that it's simply not true will also lead to discussions as to whether these decrees or ordinances have a legal basis. So yes, there is a certain status of discussion. Yes, the coalition will do something in that area, but how it will look like in the end, I think it's still open. One thing is for sure, they will look at the energy efficiency and they will further it. They will put more subsidies in that area. And what the rest will be, we'll have to see. But we'll have to calculate with a little bit of a rental break as well.
Now, I need to pick on this point again. 15% increase over 4 years, that is almost 4% per year. The inflation is at 2%. You being a landlord or representative of landlord, does it really concern you?
Well, actually, I think you have to see 2 points. One, Germany already has a legal system or some restrictions in residential. This is not a digital discussion or 0 to 1, but it's just a further step that we do face in the restrictions of rental increases. Nowadays, we have a restriction which is generally all over Germany, which is some 20% over 3 years. Now we will have in these hubs some regulations on rental increases over a 4 years period of time. If you remember the chart that Peter was putting on in regards to the rental increase in the cities over the last 12 years, the peak was something around 50% in Munich. So on a 12 years basis, you have the 4%. So for a long-term investor, from my point of view, even these restrictions in raising rents or raising the rental table raising rents to the rental table is something which is on a short-term basis might infect the calculation.
No panic.
And so over a long period of time, a holding period of time, this is something that, from my point of view, is not as important as it's been mentioned. On the other side, we do have some issues or some regulations on new leases that might infect the market a bit more or the calculation a bit more. But remember, we are just talking about the hub areas. So if you're investing in Berlin or in Munich or in Hamburg, this will be a situation that you will face. From my point of view, and as I already mentioned, there are so many other opportunities in Germany to approach other markets where it is vital to have the local knowledge, and residential especially is a local business. When you do have spotted the right areas, like we did here in the first presentation, you have to think local, and when you choose these areas, you're not facing any of these further restrictions. And so, from my point of view, it's just a matter of calculation. If you think of that it's on a short-term basis, residential. Well, Germany is a safe haven, and residential in Germany is even a safe spot in the safe haven, which is so stable. So, just to have the idea for short-term investment and short in and out transaction profit, this is most probably, well, you can get it by chance, but this is not the right general idea to approach the German residential.
We're coming to that point. The transaction cost you're facing is around 12%, depending on the volume of the property. Now, about 5% of those 12 accounts for property transfer tax. And there are ways to circumvent that. Do you see with your clients, national and international clients, are they setting up structures to, like share deal structures to avoid the property transfer tax?
Oh yes, definitely. It's not sort of white and black. Share deals is something we have seen for many years. The big residential transactions I was advising on in the early years of the last decade, starting with Kiel, Salzgitter, Viterra, etc. They have all been share deals. You always want to distinguish between who is the investor, who upon exit will invest in that sort of asset. If you want to sell a very local building, it will certainly not be a Cayman or Luxembourg or whatever share deal structure you offer. And you'll also have to bear in mind that's a different product. You buy then a corporate shell with its history, the depreciation wherever it stands. There's some red saving. There may be a latent capital gains which you have to take into consideration. But yes, investors are responding. And one thing is new due to the amended real estate transfer tax laws. Probably they will not as much as in the past invest into transparent structures because you can't exit them without real estate transfer tax. But the corporate structures, let's see how that sort of evolves.
Thank you. Now, given the cost structure of roughly 12%, a simple buy and hold strategy is probably, well, I wouldn't say outdated, but should the investors not be a little bit more aggressive? Maybe also go on a parallel basis, build up a holding portfolio and have a trading portfolio? What would you advise?
Well, it depends on the objectives of the investor, clearly.
Given a
we're
longer-term horizon.
Well, exactly. We're not talking about a homogeneous pool of capital. We have very diversified structure of investors. We closed one deal in early October for a very large international family office located here in London, and they acquired 160 million of flats in Berlin, and they're not interested in actually selling it because they want to keep this real estate exposure long term. And by long term, we're not talking about a 8-year business plan instead of 5 years. They're talking in terms of decades or even generations. So they're interested to keep that. But you're right, for other investors, it absolutely makes sense. And I believe that bifurcating your real estate, your residential portfolio into a hold portfolio and then a trading portfolio actually is a very neat way to improve the economics. Because if, for instance, you have a 30% trading portfolio of your real estate stock, then there you can get much higher returns and profits rather than just buy and hold. One of my partners has been doing that very successfully for DWS, a very large fund investor in Germany, and we've set up a number of funds on that basis. So any portfolio that we bought, we at the point when we started the due diligence and then the actual acquisition, we've put that into pocket A or B, i.e. it's a buy and hold or it's a trading portfolio. But again, the point is, in order to do that operationally, it all sounds very nice on a spreadsheet level if you sit somewhere in front of your computer and you can do the economics and the formulas. But I think that the real challenge is to do that in practice with the people on the ground. You need to have the processes, the systems, you need to have the distribution people selling flats, house by house, flat by flat, or portfolios.
Yeah, but what I don't understand when people come to us investors, they all look at obviously the same product in Berlin. They set themselves a hurdle of maybe 3 million and wouldn't look at anything smaller than that. Now, most of the houses are 1.5 million to 2.5, so they're kicking themselves out of the market just by setting the wrong investment framework, and by checking offers, they look for the ideal property, and at the same time they come across so many other properties that there are still good properties, they just don't fit the very tight criteria. Now, there are so many synergies by doing the holding strategy and at the same time maybe investing in a trading portfolio, that this is something that we would like to see happening more often.
You certainly get support from a tax lawyer because that's tax efficient.
Yeah. Now, the banks are playing a major role, as we all know. They have taken a much more conservative approach after the Lehman crisis. We are looking in Germany at LTVs of 70 to 75%. In the residential market, that is standard. Ralf, do you see the banks loosening up on their lending practice in light of the money floating around and looking for a haven to be invested? This is something that could also fuel the market even further.
No, that's right. It's a typical criteria for a bubble if you have excessive debt. So the quantity of debt increases and the quality of debt decreases, but we're not seeing that in Germany. And I have to say, I used to be an investment banker for many years based here in London and doing structured finance deals in Germany, so I think I understand the joke of modeling a portfolio and talking to rating agencies and so forth. But from my conversations with the banks on the ground, on mandates that we have and deals that we're doing, a reasonable approach. I mean, yes, 70, 75, sometimes you get 80% loan to value. And I mean, we can discuss the V within the LTV equation for many hours and who is right and who's wrong. What's the value? I think one of the things that the bankers have learned is actually the focus on cash flow. So instead of just focusing on LTV metric, people have realized that it is the cash flow that is actually the most important thing, and hence things like interest coverage ratio, debt service coverage ratios, debt yields, etc. are very important. But clear answer, I don't see any excessive behavior or loosening up or covenant-light structures. German residential is a very interesting area for German banks. They love it because they can put it into their covered bond pool, Deckungsstock, and issue Pfandbrief and all those sort of things. So it's great, it's good competition, but I think it's still at a very healthy level for the overall sector.
I get the signal. We have time for two more quick questions and even shorter answers. The banks they have to shorten their balance sheets due to the Basel III restrictions. Now, a lot of investors got in the markets in 2006, 2007, investing and financing for 6-7 years, some for 10. So this comes up for prolongation. The banks that they have been financing with, some of them are not even in existence anymore, or are just being bought out, like Euro Hypo. Do you see that being a problem first of all, for the investors finding new financing? And if they don't find, they may have to sell. Could that put pressure on the prices?
Well, actually, if you see what happened over recent years, there was not in residential, there was not too much of these situations going on. The banks were more or less refinancing or just prolonging the situation. So we didn't have too many of these situations in the past. And we'll have a panel afterwards on this in this regards. And I'm really interested to hear what these specialists are saying about that situation. I'm pretty sure that there will be some further products to come, and that there will be situations to invest in. Residential actually is not the specific area, because it's so stable, which is a matter to problems in financing situations. The banks are really active in financing, and by this you can see that the banks are really relying on the German residential real estate market. It's not just the German banks, but also foreign banks who like to finance German residential real estate. So this is a safe thing to do. But what the banks look at is who is doing the management, who is working on that, and not just only on your business plan and on your Excel sheet, but they have learned. This is the learn curve that we also learned in the first discussion or in the first presentation. They have learned that it's vital to have an in-place asset management and property management, and that you really have to have people on the ground. And with our clients and the deals that we source for our clients in residential, we are very comfortable with the situation of financing for our clients, and we are, as I mentioned in the 10 office, we are working on the ground in the local areas of residential real estate.
Thank you. So to finish off, getting the red card here, 3 good recommendations for investors who are planning to buy residential real estate in Germany. Very quick.
From observation, do not invest in herds. I heard a terrible sentence just a few days ago, which is, I'd rather lose money investing with a pack than making money on my own. That's probably then your market to do it different.
Yeah, that's a good point. I only add two more. I think look at B cities, good location within the smaller cities, and then also not only do the due diligence on the real estate, also do the due diligence on the asset manager and the property manager on the ground, because those are the guys who are actually able and in the driving seat to deliver the cash flows that you're promising.
Okay.
Yeah, prosperous regional markets in Germany are the places to invest in residential. This is my point of view. And for now 5 years, we've done a survey together with a big company, which led us to Germany 21. These are the 21 cities that we think that...
Sorry, 3 recommendations.
Well, okay, 21 recommendations for investing in Germany. So this is the places which are really interesting to invest in.
Okay. On my part, look for experienced partners on the ground. You've met some of them. Look for smaller deals. Don't go always for the big deal, because it might be easier. And on the last account, pay the broker well. It pays off in the long run.
Yes.